Global equity markets jump as Washington does a last-minute deal to avert the fiscal cliff. But bigger questions on debt reduction remain, and it may not be long before there's a fresh cliffhanger. Today's Eurozone data are also a reminder that big problems have not gone away. The figures point to a deepening slowdown in factory activity, with new orders tumbling. The manufacturers index edged down to 46.1. and has now been below the key 50-point level since August 2011. Ireland, the only country in the zone to see a rise in activity over the period. Let's talk with Christian Schultz, senior economist, Berenberg Bank, about both of these things. I want to start with the fiscal cliff and the situation looking forward in the US, Christian. The lack of rebalancing in the US, how long is it going to be before we see a downgrade, do you think?
Well, that is indeed a risk that there's going to be some external pressure after the internal pressure that we've now seen due to the fiscal cliff has really failed to produce a long-term strategy on how to deal with the cliff. External pressure might be what's coming up, but external pressure only from the rating agencies is unlikely to have a massive impact. We've seen that before in several countries when countries lose a AAA rating, or even if they lose a little bit more than that, that's not necessarily having an impact on borrowing costs, which would, of course, help to focus US policymakers. But the fiscal cliff has produced some austerity, modest austerity. That's probably enough to allow the US economy to still grow this year, which is a good thing for the US.
What rate are you looking at this year?
Sorry?
What rate are you looking at for growth this year in the US?
We're expecting about 2% growth, so about the same as last year. That includes about 1% of fiscal drag. Now, the drag might be a little higher, but the latest data has been pretty good. So we would stick with our 2% growth target for the US for 2013.
You start your note this morning with the sentence, markets in the global economy can breathe a sigh of relief. Finally, and not too late, the Congress has done this. How long is this relief going to last, do you think?
Well, if the US does not impose extra massive fiscal austerity, then this sigh of relief should really stay. But of course, we have probably once again noisy negotiation ahead of us heading into February with the debt ceiling hitting, and at the same time, the postponement of these automatic spending cuts will expire at the end of February as well. So we're going to have once again pretty noisy negotiations. But one thing that we've learned both in 2011 and now, US politicians will in the end do enough to avert major disasters striking the economy, at least if it's of their own making, and compromise in the end. So we also expect that for February, and probably markets will be pretty sanguine about that as well.
All right, let's talk about the PMIs in Europe. You pick out Italy as the star here. I mean, we mentioned Ireland because it's above 50, but you pick out, you focus on Italy and say this is very much the story at the beginning of this year, right?
Well, we think that Italy is going to follow Ireland as being the second crisis economy to emerge from this adjustment recession. Ireland is clearly out of the doldrums. Both the PMI manufacturing but also the services PMIs have been positive, and quite positive actually, the last few months. So Ireland is out of recession. Now, Italy is clearly not out of a recession yet, but talking about fiscal cliffs and fiscal austerity, the Monti government over the last year has imposed enough austerity and made enough fiscal adjustments for Italy not to need much more austerity in 2013. And that should help the economy to turn around and grow again this year already.
And given that the US receives, what, 6% of Eurozone goods exports, with that in mind and this deal done in Washington, when are we likely to see the impact, the positive impact of that in Europe, and how will that show itself?
Well, exports to the US have been relatively healthy over the last year already, and we've always hoped that the US would continue that moderate growth run that they've had, and that would help European exports. The most exposed countries to the US are Ireland by far, and then the UK. The other big European exporters usually export about 6% of their goods exports to the other side of the Atlantic, so they're also going to have a positive impact. And we have to keep in mind that the US is not just directly important, but also, for instance, China exports a lot to the US and imports a lot from countries such as Germany. So there's also going to be an indirect impact on exports from the Eurozone. Okay,
very good. Christian, many thanks for talking with us. Equities were the asset of choice in 2012, and the fiscal cliff deal is helping them make a good start to the new year. The FTSE is the star of today's chart point, The benchmark index back above 6,000 for the first time since July 2011. The omens from that period are far from encouraging, though. After briefly pushing above 6,000, the FTSE then lost around 16% of its value in the following 6 weeks. That's it from us for now. Join Reuters every day at this time to take the pulse of the market. I'm Axel Threlfall. This is Reuters.